Hello and welcome to those of you joining us just a little bit early. My name is Charlotte. I'll be your Money Show host for this session. Our next session is with Ms. Cameron Dawson. We will begin on time at 1 p.m. Eastern Time, coming up in just a couple of minutes now. I should say a few short minutes now, excuse me. I hope everyone is having a wonderful day so far and that you're enjoying the virtual expo. If you have any questions, feel free to send them into the live chat box. And of course, as always, take care. Have a wonderful time watching the show. I see we have a few more people joining us, so I'll pop in once again just to let everyone know we will begin on time in just a couple of minutes now at 1 p.m. Eastern Time. Thank you for your patience. Hello, everyone, and welcome. Our speaker for this session is Cameron Dawson, Chief Investment Officer with New Edge Wealth. Cameron leads the development of New Edge's investment themes, strategies, and market views, while also working closely with their advisors and clients. She's widely known for her differentiated and thoughtful financial commentary and frequently appears on Bloomberg, CNBC, and Fox Business, along with many other networks. And with that said, we're going to go ahead and get started here. Thank you all again for joining us. I hope you enjoy the session.
Hello, my name is Cameron Dawson, and I'm the Chief Investment Officer at New Edge Wealth. I am beyond excited to get to be able to share some of the highlights from our 2026 outlook with you all, as well as the 10 or 10-ish charts that we think are going to be really important as we move through this year of 2026. So we have a lot to get through, so let's go ahead and dive right in. As you can see here, the title of our 2026 outlook is Play the Ball as It Lies. And of course, course, this is the quote from one of the greatest golfers of all time, Bobby Jones, who said, "Golf is the closest game to the game we call life. You get bad breaks from good shots, you get good breaks from bad shots, but you have to play the ball as it lies." Now, you could probably substitute investing there in for life and talk about how you can get good markets from bad economies, bad markets from good economies, but you have to play the ball as it lies. And so that is really the key premise as we think about how we will be approaching 2026. We do note that investors always have to play the ball as it lies, meaning you have to look at the setup for, in quote, the shot, but we think that this setup is more important than ever. And that's really going to come through as we get into those 10 charts that we think are going to be really important for portfolios as we move through 2026. Now, we do think that this year is a bit of what we would call a tighter lie, meaning that you're going into the year with high expectations for growth. You're going into the year with high valuations for equities as well as credit markets. And we also have to appreciate that we're not only in the fourth year of a bull run, which tends to have a less strong track record of generating or delivering those another year of double-digit returns, but we're also in the year of a midterm election, something we're going to talk about in the charts and why that's really important for how we see things playing out. Now, one of the things as we think about our 2026 outlook is that we always have to have, as Goethe call it, the imagination for reality. So this idea being that we need to think about the different scenarios for how this market could progress. The central scenario is what we think is the base case. We're calling it slow and low. So if you happen to like barbecue, you know what I'm talking about. But this is effectively that growth slows to about trend. And that trend is about 2% growth. You might see a little bit of an uplift in unemployment and slightly sticky inflation, but it still remains contained. We're not going into a recession in this scenario, and that the economy can continue to chug along. What that means for equity markets is that you could have a bit more of a choppier market simply because a lot of good news is priced in, and you don't have that same kind of upside surprise to growth forecasts, given that growth forecasts are already sitting at about 2.4%. On the left-hand side, that's the stumbling. That's where growth falls below 1.5% with a higher unemployment rate and inflation falling to the 2% target simply because growth is so weak. Now, this is a scenario that probably is initially negative for equities, or we would expect it to be negative for equities simply because growth forecasts would have to get cut. Now, if there's one thing that risk assets love, they love when growth forecasts are going up. They don't take so kindly to risk asset or to growth forecast cuts. Of course, eventually markets will stabilize, as they always do, but that could come with the fact that the Fed is likely to cut rates to a more significant degree if we were to see unemployment tick up in a meaningful way. Now, on the right-hand side of the chart is the scenario that we're calling the hot dog summer. Now, this is inspired by Strategas, who identified that there are two really big events that could drive consumer spending as we move through 2026. Over the summer, we have the dynamic around the 250th anniversary of America, practically, with the 4th of July. But we also have the World Cup, which is being played in North America. Both things that could spur some spending. If you remember going back to the summer of 2023, we had some big events that spurred a lot of spending for consumers. We had the Barbie movie, we had Taylor Swift and Beyonce concerts, which is why it was called Hot Girl Summer. So given the fact that we're talking about America and we're talking about going to a football match, that's where we're getting hot dog summer. So this is just a simple observation that if there was anywhere for the market or the economy to surprise to the upside, it would be from the consumer in 2026, simply because consensus has consumer growth slowing from about 3.5% in 25 to just 2.5% in 2026. So if there's any room for upside, it would likely be on that. This is talking about the potential cases or potential paths for the equity market. This is not breaking any new ground. It's just effectively to say that we think that there's moderate upside with a little bit of volatility as we move through 2026, driven by EPS growth and potentially any periods of downside could be caused by either derating. Remember, valuations are high, as well as maybe some disappointments on the earnings front. To get to much lower than that, we do think you would need to see earnings estimate cuts, which is one of the reasons why we watch those earnings estimates so closely. And then on the bull side, it's that you continue to get value valuation expansion, strong EPS growth. One important thing to note, this really requires optimism about 2027 EPS growth. Remember, you're always pricing in the next year's earnings in whatever year that you are in. Which means that in order to get to that 8,000 level that some are using for a price target for the S&P 500, we think that not only do you have to see really strong performance in 2026, but again, continued optimism as we move through 2027. So let's talk about the 10 for 26, and it comes with the caveat that it's an ish to ish for 26. This is the GDP forecast. Just last night, this was updated to now be 2.4% growth for 2026. This is such an important chart just to keep an eye on, be able to say that effectively if the street is thinking that growth is going to surprise to the upside, or data continues to push growth forecasts higher, it's a great environment for risk taking and risk appetite. What tends to be not a great environment for risk taking and risk appetite is if growth forecast goes sideways or down. So this is one thing that we're continuing to watch very, very closely. Again, this number is now 2.4% as of last night. So people are getting a lot more optimistic about the US economy. Now, what's fascinating about this growth dynamic is that it's kind of happening without the labor market, or not kind of, it really is happening without the labor market. Just think about it. In this third quarter, we had nominal GDP of 8.2%, and yet we had very weak hiring and a very lackluster labor market with slowing wage growth. So this, of course, is showing up in productivity statistics because we're producing more but hiring fewer people. The question is, how long can this last? How long can we see the divergence of something like CapEx growth, CapEx intentions, which of course is very related to AI right now, with the employment market continuing to slow? Of course, the consumer is something that we will talk about as being a very important consideration in all of this. But the reality here is that typically these things move together. So a big question for 26 is how weak can the labor market be if growth remains resilient? And then what does the Fed do about it? Remember, the Fed has a dual mandate. It's stable prices as well as full employment, not growth. So if we continue to be in an environment where growth is strong but employment is weak, we could see the Fed lean a bit more dovish because its mandate is about employment, not growth. We talk about the Fed a little bit closer, a little bit further. It looks like the Fed is getting close to the end of its cutting cycle. As you can see, the spread between the 2-year Treasury yield, the Fed funds futures implied rate at the end of January 2027 and where the current rate is starting to close, effectively saying that one, maybe two more cuts, not necessarily expecting much further deep cuts. And this is the bond market sending a message that it doesn't think that the economy is going to be falling off a cliff. If the bond market thought that economic growth was going to be far weaker, you probably would see this implied rate on Fed funds be below 3%. Think of 3% as effectively the neutral rate, the rate that's neither stimulative nor restrictive to growth. So if growth were to soften, you'd likely be below that 3% rate. So right now, the bond market at least, looks very sanguine about the growth outlook. And as we talked about, so does the equity market. One of the things that's really fascinating to watch, of course, is what's going on within bond markets. And here we ask the question is the cost of capital actually falling? Meaning there's been a lot of expectation, if we look at the strong outperformance of things like small caps, for example, in the US, that you're going to see a movement lower in the 10-year yield. A lot of hope with things like home builders. You're going to see a movement lower in the 10-year yield, and a lot of optimism around smaller business lenders, borrowers for that matter, that there's an expectation that the cost of capital is going to fall. This is showing long-term rates, which of course is not necessarily what a lot of businesses borrow at. They tend to borrow at the front end of the curve. But what you can see here is that long-term rates continue to press higher. I mean, the 40-year bull market in bond is long dead. But of course, we've seen this really big movement in Japanese yields. This is as of last Friday. So this is before we saw some of the bigger moves in yields. So the key message here is simply that the long end of yield curves continue to drift higher, which may be a little bit of a challenge to some of those hopes and dreams that you get long rates to move lower to support the housing market, at least in the U.S. The other really important thing to watch, of course, is what's going on within 2-year yields. We're watching 2-year yields really closely because that's effectively what the market is expecting out of monetary policy. No surprise that two-year yields are moving higher in Japan as people expect the Bank of Japan to continue to tighten. But they are moving higher in Europe. Here you can see in Germany, two-year yields have moved off of their lows from 2025. And a big question for the US is whether or not this downtrend in two-year yields, which has been so persistent and so powerful for markets over the course of the last 3 years, if that continues. The two-year yield downtrend has allowed financial conditions to remain easy, it's added to liquidity, and it's allowed the Fed to effectively deliver cuts in an environment where growth is still remaining resilient. And so the big question is either A, does growth remain resilient and they're cutting for a bad reason, or B, do they have the degrees of freedom to cut further if growth is that resilient? Now, one big question as we move into 2026 as well is, will the old economy strike back? And one way to think about the old economy is just moving goods around. And here you can see there's been a massive and incredible divergence between the relationship between the old economy, here we show it with the Cass Corp Freight Index, and the S&P 500. And it used to be that these two things would move together, and that made a lot of sense. The more stuff you were moving around in the economy, the more likely you were seeing earnings growth and economic growth, and thus the equity market would move higher. But ever since the pandemic, that's completely broken down. You've seen Cass Freight shipments be much weaker and staying, of course, well below their 2022 peaks, but not participating in the upside that we've seen in markets. And that makes sense, as we've seen markets being driven by a lot of more intangible things, such as the cloud and AI and all this tech stuff. But as we're learning very quickly, just because it's digital doesn't mean it's also not physical. And so as we've seen a lot of optimism show up in things like industrials and energy and material stocks, the idea being that the build out of AI infrastructure is going to have a lot more physical demands to it than maybe people appreciated. Will we see it result in more shipments? We've seen a lot of perkiness out of transportation stocks of late, but it'd be nice to be able to see a little bit of confirmation on that front and this divergence not to persist. The other big point is the question of, can earnings deliver? And if there's one thing that's the most important question in all of this, it is this one. Earnings are the most important driver for stocks, but the important thing to remember is that turns in earnings typically do lag turns in stocks, meaning that if we look back in a year like 2022, stocks, or 2023 for that matter, stocks bottomed a lot earlier than overall earnings did. But what we've seen over the course of the last 9 months or so is that earnings have effectively hockey sticked higher. And if you want to see it, it removes the S&P 500 black line. It shows you just the blue line of the 12-month forward earnings estimate. And here you can see the incredible step change function higher in earnings estimates. And remember, this isn't realized earnings yet. This is the expectations over the next 12 months. And here you can see just how high the bar is. In a period that is just kind of a normal growth period, not a period coming out of some big, deep, dark recession, this is an extraordinary growth rate. It is an extraordinary growth rate. If you go back any time outside of a period like 2018, which of course we had corporate tax cuts, which were an immediate boost to the overall reported earnings. But the tax cuts we're getting this time around aren't that immediate of a boost to corporate earnings. Of course, we have some benefits from things like accelerated depreciation, but this is an incredibly high bar for companies to be able to jump over in order to deliver on these expectations. And one of the things that's fascinating is people say, yeah, well, we're getting things like fiscal stimulus and monetary stimulus, and it's a midterm election, and we're going to see a lot of benefit from the midterms and the spending to effectively make sure that whoever's in power tries to stay in power, which is what we typically see during midterms. And this is a great chart from the global liquidity indices. Michael Howell, who is holds the high ground and insights on liquidity, and he had this great chart that he shared on Adam Taggart's podcast, Thoughtful Money, where he showed that EPS gains in presidential terms, that second year, that midterm year, are typically the highest that you see during the market cycle. But fascinating enough, that right-hand chart shows that the price return that you see in a midterm year is actually the worst you see in the presidential cycle. So for all of the talk that people are having as to how there's going to be a lot of juicing of the markets in 2026, it could be that it juices earnings, but that doesn't necessarily translate into juiced returns. So certainly something to watch. Another great example of this notion of play the ball as it lies. Keep this in mind as we motor through 2026. One last thing, just on the earnings front, is the question of, can the margin miracle materialize? I should probably reframe this some, because we think 2025 was already a margin miracle. Here you can see the kind of breakout of margins above what we saw from revenue growth. Usually margins and revenue growth move together. It's by that great dynamic called incremental margins or contribution margins. And so what we saw in 2025 is companies were able to expand margins even though we didn't see an acceleration in revenue growth. And that's likely because of things like falling wage growth, lower quits rates, workers staying in their jobs longer, making them more productive, investments in certain technology coming out of the pandemic that are just starting to show their benefits now. This is likely not about AI yet. Now, it's not to say AI benefits aren't coming, but this kind of productivity is likely not a reflection of AI applications yet. Could make you more bullish because you say, great, the AI benefits are in front of us, or it could make you look at that 2026 estimate and go, oh, wow, that's a very high bar, given the fact that AI might take longer to materialize in markets than some are expecting. One last thing on the equity markets is this question of, can valuations defy gravity? Here we have valuations that have been hovering in this 22 times forward range, really since the beginning or end of 2024. Markets remain very expensive no matter which way you cut it. And again, it really depends on the path of earnings growth forecasts. If earnings growth estimates are being revised higher, we think valuations can remain and levitate at these highs for a short period of time. But if you start to go into a growth scare, similar to what you did in 2022, certainly you would be in an environment where there would be a lot of room and a lot of air to come out of valuations. I said that was one last chart on equities, but I promise this is the actual last chart on equities. Is just the question about whether or not growth versus value is the start of a great rotation. Really too soon to call. The hardest things about major sea changes or tectonic shifts in markets is that the beginning of them looks a lot like a counter trend move. And what I mean by that is that you've seen a lot of head fakes in this growth versus value ratio. Growth has been the ultra dominant part of the market really since 2008, after value had its days of glory coming out of the tech bubble. And a big question is there enough room to come out of tech, for example, in order to be able to fuel some of these value rotations? For us, it really comes down to earnings. If value earnings are continuing to lag growth earnings, as they have consistently over the course of the last 3 years, then we think that growth can resume its outperformance over value. But if you start to see some improvement in value earnings, certainly that could be cause for further rotations. One last chart is a big thing if you're a private market watcher, is just the question of, will capital markets reopen in 2026? There's been a lot of talk about big IPOs. There's been a lot of talk about companies finally being able to go to market after years of having to sit on the sidelines. And so one thing to watch is this IPO index versus the rest of the market. Usually when this is outperforming, it's a time when companies are really wanting to bring things to market. It's a sign that, get in, the water's safe, everything's fine. And so it'll be something very fascinating to watch, mostly if you have any kind of private market exposure. So that leaves it there for me today. I'm so thrilled for this opportunity to get to present to you all, wishing you all a safe, happy, and very abundant.
All right. Thank you all so much for joining us. I do realize that Cameron finished just a little bit early here, but the next session will be going on if you want to go ahead and tune in just about, I believe, 15 minutes from now. Let's see. Yes, so it's going to be starting at 1:35 p.m. for the next session, so do be sure to stay tuned. Thank you all for joining us today. I hope you have a wonderful rest of your day. And to those of you in the live audience who shared questions, I will make sure that Cameron receives those so that she can hopefully get in contact with you. Thank you again. Hope you have a wonderful rest of your day. Take care.